I think we need to be careful what we wish for here. So the market clearly loved this pullback from the Fed, this change in tone. But is inflation actually under control? Fed has certainly suggested a change in course here as of yesterday. My name is Brandon Steele, financial advisor with Mainsail Financial Group here in Bellevue. And our goal every Thursday is to bring to you the market news, the data, the trends that we're watching, and hopefully weed out a bit of the noise along the way. And we have a lot to cover. So just as a heads up, we will skip our question of the week this week, because as you might imagine, this is really all about the Fed. And maybe as soon as we thought that the spotlight might be dissipating a little bit on them, they take a big shift in their narrative, and we are like right back on focus on the Fed here moving forward. So before we get to some of the changes, I do want to talk a little bit about the inflation data that's come out recently to kind of set the stage. So right before Fed press conference and decision yesterday on Wednesday, we also had inflation data come out on Tuesday. So we had CPI data come out on Tuesday, and CPI was up 0.1% versus expectations of basically being flat. But it is an increase from last month. But even more, what I want to touch on is a little bit is core CPI. Now, that said, the headline CPI number, keep in mind that adds energy and food into the mix. Basically, the interesting thing with this number, just to be very clear, is that the way I see it, this is still quite the surprise, because CPI was up on Tuesday by 0.1% for the month of November. However, energy was still down during that period. So oil prices, right, a lot of these energy factors have certainly come down again this past month. And even with that, we see CPI up, basically up 0.1%. And again, kind of, an increase from last month, even with that in mind. However, where maybe we want to spend the most time is core CPI. So core CPI, again, takes out food and energy. This is where the Fed focuses a lot with their data. They always, if you ever hear them say core inflation or core CPI, this is really what they're referring to. And again, it's basically CPI stripping out food and energy. So core CPI was up 0.3%, again, in line with expectations, but it does keep the annual core CPI data at 4%. So an annualized inflation rate of 4% based on this data point in particular. So obviously far above the Fed's supposed 2% target. So I guess the takeaway from all this is we've got inflation that may not be in check, certainly is not nearly the 2% kind of target that the Fed keeps talking about is so important to them. So the Fed likely to be more hawkish, right? Well, the answer is no. The Fed basically says no change yesterday, which was expected. We kind of talked about that last week. However, they're starting to price in 75 basis points of cuts in 2024. So if you followed the markets yesterday, the markets loved this. Stock markets were up, bond markets were up as interest rates came down. But it's just, I think, a little bit surprising given what we saw on the inflation data. It certainly is showing that it's coming down, don't get me wrong, but we've still got a long way from 4 to 2. So I think that seems to be the surprise here in this huge change in tone. For those who remember, if you go back 2 meetings ago, so that would have been, I believe that would have been October. In October, it was basically the tone was we will continue to explore rate hikes until data says otherwise. The last meeting in November said basically we're done unless the data says otherwise. And then this most recent meeting basically suggests we're going to cut. The only question is when. So it is quite the shift from where we were just 2 months ago in terms of how the Fed is looking at things. For those who know the terminology, I guess, there's this hawkish approach or dovish approach. Hawkish basically meaning that the Fed's being very aggressive. They're raising rates. They're going to do all they can to deal with it. Dovish meaning basically they're more conservative. They're, hoping to stimulate the economy or at least kind of change their stance. And so we went in 2 months from a very hawkish Fed to a very dovish Fed, and very quickly. Last week when we had talked about this, we had suggested that there probably was going to be no change in the actual rate. And I think that is the case as well, but that the press conference would be the biggest thing to watch. And that certainly did not disappoint, or at least for entertainment purposes anyway. So basically, again, you get the gist of the tone that came out of it. But if you start to unpack some of the questions and the answers from the Fed as well, there's a lot in there that I think we can glean too. So basically, they took off the table the idea of any more hikes. I mean, it's possible that we could still see some hikes, but in the way that they were answering questions, I would say they all but are taking that off the table. So, they still always talk about the data suggesting what may be next, but it was very clear that for them to hike would require a significant change. So let's just say hikes are maybe mostly off the table at this point. What he said, I think a few times even, was basically the next question is when to start cutting rates, not if, not, as we go through the later part of 2024, but when we start cutting rates. So it really seemed like the answer to every question was basically suggesting that the discussion is now really all about the when, not the if. And I think that is a big shift from where we've been as we looked over the past few meetings. One of the things that I thought was really interesting as well, this was one tidbit, so I'm not sure how much weight to put into this, but he did suggest that he expects the real rate is to decline moving forward. And for those who aren't too familiar with this, the real rate is basically the interest rate that we see in the economy, and then stripping out inflation from that. So just basically the real rate minus inflation is maybe the simple way to think about it. So if he expects inflation to come down, there's two variables, interest rates and inflation. If he expects inflation to come down and he expects the real rate to come down, the only other variable, if it's going to come down, would be interest rates. And if he expects the real rate to come down, that means that gap actually narrows. So in other words, what he is suggesting by saying this is that interest rates are going to come down further than inflation moving forward, right? So this was a big takeaway. That suggests a very dovish Fed in terms of how they may look at cuts next year. So I guess the biggest thing I would suggest as far as a takeaway is this term dovish, and we're going to hear this a ton as we look forward now. Again, as soon as we thought maybe the Fed was just going to step back a little bit and see what happens, this is what we got out of it. So that is the biggest takeaway I took out of, not only the decision, but also the press conference afterwards is they are certainly looking maybe more towards a different stance in how they approach policy moving forward. The thing I want to caution is I think we need to be careful what we wish for here. So the market clearly loved this pullback from the Fed, this change in tone. But is inflation actually under control? That is the biggest question that I think still remains. I posed the question last time to basically get a sense of whether or not the Fed may be making a mistake. And it wasn't about holding rates. It's actually about cutting. And so that's the concern that I have here. If inflation is still sticky, and again, there are signs that it's coming down, but if it is still sticky and the Fed moves too quickly, we could end up right back where we were, and that could be a huge challenge for all of us, certainly, and the economy as a whole. So again, just be careful what we wish for. Although the Fed talking about cutting rates is a good thing, there are other implications of that certainly could create some challenges in the future if they do it too quickly. And I will share that, from my perspective, if you think back to when the Fed started raising rates, they certainly moved too late, in my opinion. That's why we had so much inflation and all these challenges that we've been dealing with. So, to say that the timing is perfect, would be hard to justify. So anyways, we'll see what they do. Hopefully they are patient before they start making these moves, but they certainly are setting the table for some cuts to come next year. The last thing I want to end off on is kind of a quick refresher, because one of the biggest things in the market from yesterday was what happened with interest rates. So last Thursday, we talked a little bit about the 10-year yield and how it had fallen from 5% to 4.2, and now it's almost a 4% flat. Yesterday, the 2-year Treasury, 2-year yields dropped over 30 basis points during the course of the day. And that's like a 7% move roughly in interest rates. So there was a huge impact to the bond market yesterday. And whether that holds or not, I think that there's certainly a lot of a lot of speculation around that, and plans that this kind of tone will continue. So we'll see how long that holds, but nonetheless, interest rates dropped significantly, and the stock market had a great day yesterday as well. So we will see how long this continues, especially as we move closer to the holidays. But a lot to break apart here. Thanks, as always, for tuning in. skip the question of the week this week, but definitely stay tuned next week. We'll talk a little about market movements over the course of the week following the Fed, and then we'll also talk a little about some housing data that comes out over the next week as well. Have a great weekend. We'll see you next Thursday at 3.